Good evening, everybody. Welcome to this weekly recap. Right now, it is currently December 17th, Sunday evening. We are doing this right ahead of the Monday market open. So, the new trading week is set to resume tomorrow. So, in this video, we're going to be discussing the weekly sector review. We analyze the price action of all of the S&P 500 sectors on the weekly time frame. This is important for investors and trader because it identifies A, is there going to be profit taking? B, which sectors are set to outperform, underperform? And C, it gives us insights to whether or not we're going to see capital rotate from one sector to another, or if we're going to see more or less a broad market sell off. So there's starting with XLK. Technology is the most important sector to pay attention to because it has the largest market cap weighting in the S&P 500. So that is super, super critical to pay attention to. XLK, we've been touching base on XLK. First things first, the weekly chart, the monthly chart, it's a massive, massive trend line of resistance going back 23 years. Now, as of Friday, we did break out of this trend line. So you have to respect that we are above that right now on the weekly chart. We have not confirmed the technical breakout yet, but right now, next week is on watch for a confirmed technical breakout in the XLK ETF. Now, from a trading standpoint, typically when you get 1, 2, 3, 4, 5, 6, 7, 8 weeks of consecutive upside into a massive resistance, you typically don't hold this breakout zone. So I think that this could be a little bit of a fake weekly breakout before rejection comes in. Now, as long as you consolidate above this wide range green bar, since this is now your breakout candle, this wide range green bar candle, the low is sitting at 185.68. That is going to be the line in the sand where you would likely stop out of your position along with other market participants. If we were to consolidate for many weeks above this area, then this breakout is going to look more promising to trade to the long side. But if you get a weekly close back below this trend line, and more specifically taking out this weekly low candle, this could be a potentially a failed breakout. I'm leaning with this being a little bit of a fake out breakout, but time will tell. Obviously, the market's going to do what the market's going to do, but I am not buying this little bit of a breakout right here. I need to see more sideways consolidation, another potential flag pattern to trade off of, but we are technically above that. Now, the XLK, in terms of its performance, and I apologize about the background noise, my dog is barking, but year-to-date performance, XLK has outperformed everything. It's up 55.88%, just year to date. Think about those whopping gains. Think about if you're an investor and you have 55.88% in an ETF in basically 1 year, are you going to take profits or not? Most people probably will be trimming. Now, over the 1 year period, it's full 365 days, you're up 44.84%. Still a whopping gain and a stellar performance nonetheless. Just the 3 month period on the XLK is up 11.17%. It has been so concentrated in the XLK. The XLK market weighting has now moved up to 29.1% in the indice. That is such a saturated. I think we're hitting levels way beyond '08 and 2000 in terms of market saturation. Many people are just hiding out in one specific area of the market, which is technology. And what's interesting is that's what we actually saw on Friday. Friday, you had every sector red except for technology. Technology did, though, on the daily chart, it did make a new high, but it failed to close above that high. So you were seeing people piling in when the market was weak, specifically the S&P, and then tech actually made a new high as the markets were going down, and then it closed back inside of the previous daily candle. The volume at these levels is showing us that, again, distribution is occurring. Sellers are also present. Just be careful. If you're chasing this market up here, you're likely going to be a little bit of a liquidity grab and could potentially be shaken out if you get a few consecutive down days of price action. But nevertheless, market is still overbought on the weekly chart in the XLK, and you are wielding a huge weighting in the indice of 15.4 trillion, 29.1% market weighting. That is absolutely insane for technology to be bolstering. The happy medium where technology usually trades is in around the range of 22 to 24% of the market weighting, and we're at 29.1. So we're a whole 5.1% weighting oversaturated in the technology space, which tells me on a historical basis, we're likely going to see a correction, or at least capital rotating out of the technology space into the others. Just for instance, the utility market's only 2.4% weighting of the market. The real estate's only 2.46, and materials is 2.4. So if you wiped out the whole materials, real estate, and utilities market with the little bit of saturation that's in the technology, that's just how big and how much saturated we are in the technology space as of now. All right, let's move along to the next sector, which is XLB. So materials sector is interesting because this one's looking actually bullish to potentially break out. It's still extended. Don't get me wrong on the weekly chart. But this one's testing a key breakout trend line, and you actually have a beautiful inverse head and shoulders. You form this nice little left shoulder, you form this beautiful head, you form this beautiful right shoulder. The upside momentum off of this pattern really can take you to some crazy. Important to watch is very, very key. We have not confirmed the break on the daily chart. Look at the daily chart. You had that gap up over resistance. You had one day of holding above the gap. You had a second day, but you have not confirmed a daily candle above this previous pivot high here. So the breakout on the daily chart has not been confirmed yet, and the breakout on the weekly chart has not been confirmed yet. If you get another weekly close above this, call it $86 level, then you wait for a sideways pattern, a nice bull flag to form on this trend line, and then we buy it long. So keep XLB on your watch because this sector has it's had a lot of consolidation. We're talking about a almost a 2.5 year range here that we've been consolidating in. So this pattern has coiled enough on the long-term basis to actually break out to the upside. Obviously, XLB is heavily influenced by the market. So definitely pay attention to that. Right now, the material sector is bolstering only a 2.4% weighting, 2.37 trillion market cap. So it's severely small percentage of the market, which means that if a little bit of money rotates, say, out of the tech space, you could see the sector absolutely rip. So I do like watching XLB on the long side once we get that confirmed break and consolidation. All right, communication sector is up next. XLC is very, very interesting as well. XLC had that multi-week consolidation. You broke out. Technically speaking, communications are still at resistance. Now, the one thing about trading XLC and what I don't like about this ETF is that it is the most skewed ETF in my opinion. Why is it the most skewed ETF? Well, Meta alone represents base price action. It's basically the exact same as the XLC. But when you have an ETF that is basically dominated by about 20% in one stock, that doesn't give you a true sense of how the other stocks are going. So what I encourage people to do and what I kind of do is for my members and myself, I track the individual stocks in that ETF and I kind of do a comparison to Meta. But basically, since Meta is so heavily dominated, 20% of the XLC is Meta, a lot of stocks that are weak, but generally speaking, because Meta dominates this ETF, it lifts the ETF when Meta does well. Obviously, the same is true if Meta does poorly, it completely causes it to fall. Just notice this trend line, pivot to pivot to pivot. I've been watching this trend line really since we head back here, and we haven't established above that key resistance zone as of yet. You are putting in a little bit of bearish divergences on the weekly chart, which makes me a little bit skeptical. What's a bearish divergence? We'll quickly summarize things. You have made a high here on the RSI, basically on this green candle all the way back in July. Then you had a pullback on the RSI. Now you've made another attempt, boom, a push up on the RSI, but you've made a lower high on the RSI. So here's your high, here's your lower high. You've made a lower high on the RSI, but you've actually made a higher high price action. So again, note, your high on the RSI aligns with roughly this candle here. And then basically you've made a higher high in price action, but a lower high on the RSI. That is a relative strength divergence. The trend is weakening. It is showing that, okay, people are not buying up this market and this ETF as much as they were. So just caution and pay note. I'm personally not buying XLC here because we are stuck at resistance. I want to see more consolidation and a pullback to the next support level. Even some sort of a pullback back to this upsloping trend line would be a little bit better as a risk to reward setup to buy on the long side. So again, if you were to pull back inside of this range, which I think is likely, then you could see XLC as a better risk to reward setup. But right now it's a no touch for me. And again, it's one of the ETFs that I don't like trading as much because it is so heavily skewed with Meta. Let's move along to XLE. Energy saw a little bit of a bounce because oil got a bounce and natural gas got a bounce. One of the rotation trades I'm looking at here is energy catching a bid and technology taking some profits. So I think energy is the safe place to be right now. Energy is one of the only sectors at support. Many of the other sectors are at resistance. Energy did get a nice little bit of a weekly reversal candle after it pierced this key support zone, and it did happen on volume, above average volume on the weekly chart. So it's looking poised to move higher. Now, energy could potentially break this area. Why do I say that? Well, energy has tapped this support zone how many times? Once, kissed it over here twice, just missed it 3 times, 4 times. So we've tagged this support zone many times. And the issue that I have is that you look at this price, here's your high. You actually made a lower high on the price action. You failed to break out. Now, oil's had a massive, massive sell off all the way down to the low 70s. So you would actually respect the price action oil and favor a continuation bounce here. But it you have to watch the support level. If the market broadly sells off and we see energy getting hit along with technology, take that as a cue that we're likely potentially setting a turn in the market for the downside. What you want to see is capital rotate into other sectors instead of just being pulled out of the market. So that's what I'm watching for, is capital rotation, or are we going to get liquidity withdrawn from the market by participants? XLE right now, in terms of its year-to-date performance, energy is actually down 5.06%. Its 3-month performance is down 10.25%, and its 1-year performance is down minus 2.14. So again, 1-year performance of energy is up +4, or of technology is plus 44%. 1-year performance of energy is minus 2.14. Technically, this is the more oversold sector. Will we see capital rotate? Time will tell. Oil needs to hold firm, though. And if this level breaks on the XLE, you've actually triggered a head and shoulders. Here's your left shoulder, here's your head, here's your right shoulder. It's a very difficult one to see because the highs are so close to each other, but it does form the technical pattern of a head and shoulder. So I'm waiting for a weekly close. If you get a weekly close below this, then that is going to be very, very negative for the markets, because typically what you see is energy falls twice as fast of technology in a big, big market sell-off. That's what the historic is on. Watch for a continuation move. The only thing I don't like about XLF is the fact that you've had now 1, 2, 3, 4, 5, 6, 7 weeks of consecutive upside. Look at the resistance trend line you just tapped. Basically, this is where you had your big neckline breakdown of this bearish pattern. You were rejected here, rejected here, rejected here, rejected here, and now you're tapping that area. Volume is increasing, big level. Notice how you tap that area on the daily chart of XLF, and look at the volume that came in. Look at those candles. Potentially a little bit of an island gap started, where you have a bullish gap open and then a bearish gap open. This is called an island top. It's a very, very strong technical pattern that suggests downside. It's not a guarantee, but it's a high probability of potentially downside. Weekly chart, again, still at resistance. One of the reasons financials have done so well, you just look at what yields have done. Yields have collapsed over the last 7 to 8 weeks, so it's pretty much done a complete inverse move of what financials have done. So definitely looking at financials for some weakness as we head into the market. I am expecting those yields to bounce. And I will take a look at semiconductors RW. Just bear with me. I did touch base with my members, but I'm just doing all of the sectors of the S&P 500 for now. But if there's time, I will. Industrial sector. Industrials, in terms of its year-to-date performance, is up plus 14%. 1-year period plus 11%. So industrials are also trying to break out here. Take a look at this pattern. And what's interesting is this is a very similar pattern to, say, materials. Industrials right now, basically, I could see the industrial market after the strong weekly close probably pushing up to the high range of this channel, call it 116, just as an easy whole number. But industrials are interesting because industrials actually formed, again, this larger left shoulder, inverse head and shoulders, and you can see it clearly here. So this was your left shoulder, here's your head, and now you formed a nice right shoulder. So this is, again, a technically bullish picture. The only thing, again, with the same trend or the same common theme in most of the sectors, it's overbought on the daily and weekly term time frames. So right now, I think industrials can still push up, but it is overbought at the very least. But this bullish potential pattern, if we were to actually just remove this trend line here and draw in our neckline, let's just see where we can draw in our neckline. So you could draw it like that. The only problem with this is that you did get a couple week closure below the neckline, which in technical analysis theory suggests the pattern has failed. But let's give it the benefit of the doubt because you have reestablished a trend back above that area. So again, if you were to continuation move over the next year or so, this pattern could suggest a move all the way up to $125 on the charts. Now, again, I'm not a buyer here, nor am I a seller. You're not at really any massive technical resistance you've actually broken through, but I am not a buyer. Where I would continue to look for a buy is basically if you got a retrace all the way back down to this downsloping neckline. If we were to retrace in and say this vicinity where you have this parallel channel of support and this downsloping neckline, that's where I would likely be a buyer. So call it the $100 whole level number. But right now, again, it's not a sector that I'm liking on the long side nor on the short side. XLI right now in terms of its market cap weighting in the overall S&P 500. Let me just pull it up here. So industrials, it's fairly low on the chart, but industrials are a very, very small sector of the market. They're only bolstering a market cap of roughly 8.37%, still bigger than the real estate and a couple other sectors, but 6.6 trillion total, 8.37% of the market. So it's still a fairly important sector to pay attention to. All right, let's move along to making new highs, not trying to break out. And that's a little bit interesting to me. Typically, XLP, you'll see it as a move to safety, a flight to safety if the market is going to sell off. We haven't really seen that yet. You've had a nice move off of the lows on XLP. You've retraced this pivot. I still think there's downside. I think you've established a new range to trade against in XLP, and it's really going to be this high pivot zone here. This trend line really at $64.70, $64.70, $65 to basically your high here of $71. So you can see that XLP tried breaking out and then got rejected and closed back inside of that daily hammer candle, which is your resistance. So watching this level, if you start establishing and consolidating above the $71 level, then the next resistance on XLP is actually going to be this upsloping trend line. That was your main trend. So this was your COVID trend with the QE low rates that it established. Expect a retrace to the high end of this channel or high end of this trend line if we consolidate on this range. If you lose the $71 level, then it opens up the probabilities for a move back down to about $65, your pre-COVID collapse high. XLP right now, again, it's not one of my favorite sectors. I'm not really holding any positions in it. So I can't really comment too much other than that on the overall. Why interest rates have fallen. Interest rates have really given up the bullish price action here. And what's interesting about real estate is that you had this bearish pattern that triggered. You can see this was your head and shoulders, left shoulder, head, right shoulder. Basically, real estate confirmed the break, never fulfilled the downside, and then reversed and recaptured the neckline and is now closed above it for 3 consecutive weeks. So it has turned this bearish price action into a bullish reversal. So what does that mean? Well, that likely means that we can now start accumulating real estate stocks on the long side. However, I won't be buying here. Like I said, I think that you get a pullback to this upsloping trend line. This upsloping trend line is now your big level and line in the sand. That's your main trend. As long as you establish and can consolidate above there, the buying opportunity in real estate is every time you hit this trend line. Basically, you can start to build in and accumulate a position. That's, or at least what I'm looking at on the real estate side. So pay close attention to that because I do like this sector as an accumulation mode, more of a swing trade versus day trading. Right now it's extended. I do think interest rates are going to bounce, so therefore this sector should come in. But I could see a pullback in this sector right back down to support, which would be about a 7-8% drop in the coming weeks that I'm expecting. And that should be healthy. That would be very, very healthy. Now, the interesting thing about this sector is that you were in a defined downtrend. What is a downtrend? Lower highs and lower lows. Here's your high, lower high, lower high. Let me actually just draw this in so it's easier for you to understand. High, lower high, lower high, lower high, lower high. What have you just made right now? You took out this high, so you've made a higher high in the trend. That is signaling to me and market participants that, okay, maybe the trend, the downtrend, is officially broken in real estate, and pullbacks can be used as an accumulation opportunity. So the fact that we've now made a higher high in the trend leads me to think that, okay, the downtrend is broken. It doesn't mean we can't still sell off, but it just means the downtrend is going, and we're now entering a stage 2 basing formation, an accumulation formation. And that means that dips and pullbacks should be bought. And the accumulation formation may be, if we do a simple channel, it may be this channel over here, something looking like that. It could be, dips could be bought at the low end of this channel, but this is probably going to be establishing a basing formation now. So pay close attention to this once it hits the lower support levels. You'll have support basically at this pivot. You'll have support at the upsloping trend line, but pay close attention to how this sector reacts off of support, because that'll give us an indication whether or not bigger investors, long-term buyers that typically move the stock, are accumulating. So XLU has had a pretty big bounce off of the lows. Also one of the sectors that is heavily influenced by what yields are doing. Notice this sector tried making a higher high in the trend, but it got rejected on the weekly chart. You also got rejected with a huge weekly topping tail on volume. The importance of this candle formation is that it is a weekly reversal candle, and it happened on an extreme amount of volume. And I warned you that there was a death cross that happened a few weeks ago where you have the 50 intersecting with, and again, you can look back at the previous view. You had a death cross that happened a few weeks. Typically, many market participants on the retail side short the death cross, but that's actually a buy signal. Whenever you get the death cross, that is actually a buy signal for a quick swing trading bounce. And then once it retraces to that same resistance, and if it gets rejected just like it did here, that's when it becomes a short. This is signifying a massive downtrending change in the utility sector. So the utilities also did not take out the high here. So therefore, still technically speaking, we're making lower highs in the trend. Unlike the real estate that made a higher weekly close, real estate or utilities did not. So it is showing us a potentially bearish trend continuation in the market. In terms of utilities is only 2.4% of the weighting of the market cap, so not really that important. 1.6 trillion deep, so it's fairly small in the grand scheme of the market. So definitely pay close attention to what utilities do moving forward. Just going to turn off those moving averages yet again, just so it's clearer, easier to focus. But XLV, again, has not made higher highs. So you have your high, lower high, potentially a lower high. You can see it tried piercing that area on that weekly candle, but got rejected and is looking to close back inside this resistance. If you get rejected at this resistance, which is looking likely, you're probably going to head back down to the low end of this range. So call it, a move back down to this low end of the range. And again, what I'm watching for is, we've seen typically how healthcare moves is you often see technology and healthcare flipping back from each other. Because technology and healthcare are two of the biggest sectors along with financials, you often see once money rotates into technology, it comes out of healthcare. Once money rotates into healthcare, it comes out of technology. You often see that rotation trade back and forth. But we haven't seen that. We've seen healthcare rallying and technology rallying, two of the largest sectors rallying together at resistance. Leaves me a little bit skeptical of the market trending higher. And again, I don't like the fact that healthcare is still putting in lower highs despite the S&P trading almost at new all-time highs. Just think about that. Shouldn't most sectors be making new all-time highs and higher highs, breaking downtrends, if the S&P and the Qs are almost at all-time highs? That just really emphasizes my point earlier in the video, earlier in the stream, as to how saturated this market is truly becoming in terms of just everyone piling into the tech space. All right, let's move along to the next sector, which is, let me just touch base on the XLV's performance. XLV's performance is up or down 1.7% year to date. 1 year performance down 4.3. So there is a chance that if you see rotation out of tech, it could come into healthcare, and then healthcare could break out. This is a long healthcare. This is shaping up to be a rather large coiled bull flag pattern. So just pay close attention to this, because it could start to break out momentarily here. So I'm watching healthcare very, very closely because it has put in a long consolidation range, and we'll see how it reacts off of this key resistance zone. All right, let's move along to the next sector, which is the final sector. This one's super, super interesting because it has formed a inverse cup and handle, or sorry, inverse head and shoulders pattern. And this sector is dominated by Tesla and Amazon. Look at that clean break of the neckline. A massive, massive weekly breakout on XLY, triggering this inverted head and shoulders pattern. This inverted head and shoulders pattern is massive. We're talking about a 50-point rally from this neckline, so it puts us all the way up to about 225 on the charts. 225, 235 takes you all the way up to here. So if this pattern plays out, Amazon and Tesla are going to absolutely rip, along with other XLY stocks. Now, XLY, in terms of its year-to-date performance, is up massively as well. Consumer discretionary is up 40.92%. It is the third best performing sector behind tech and communications. In terms of its one-year performance, it's up 31.44%. But watching this pattern for a weekly close back above this high. So this high of this weekly candle sits at 179.65. You get a weekly close above 179.65, then it's all out long side on Amazon, Tesla, and some other consumer discretionary stocks. However, just because you confirm a breakout doesn't mean that we're going to charge all the way up to this in a straight line. Often you get, a lot of pullbacks. What I'm looking for is we get a weekly close above there. I don't buy the breakout. I buy the retest. If the retest holds, then we're off to the races, and then we create that stair-stepping pattern. But never try to just buy the breakout, because that's where market makers really take advantage of you, and they start to drop the price action and kind of shake you out of the position. Now, if for some reason we get a weekly close back below this trend line, then this pattern is negated. Obviously, then you can't calculate the downside target, which leads me to suspect that we could have a failed breakout. So a weekly close back below this trend line gets you negated, but a weekly retest of this trend line, and if it holds, could be a good entry on the long side. So to sum things up, most sectors at resistance, not many sectors at support other than energy. A lot of sectors have put in consolidation. Some sectors have not put in consolidation. The most overbought sectors in the market are technology. The most saturated sectors in the market are technology. And when a sector becomes so saturated and most market participants are leaning on one side of the fence, or everyone's on one side of the boat, typically that doesn't end well for the market. And that just leads me to suspect that, hey, why did we see so much selling in every sector but tech on Friday? Perhaps they were trying to keep the markets from falling too much and disguise the selling that was commencing under the hood. And again, if the XLK drops by about 5% in weighting, if that liquidity comes out of the market, it is going to put massive strains on the S&P and the Qs. However, if that capital rotates into other sectors, then there's going to be huge opportunities across the board. But overall, I have to lean more bearish right now because of the fact as to how extended the tech space is, how saturated it is, not only on a 2023-2024 basis, but a historical basis. The fundamentals right now are not lining up. A lot of interesting price action is unfolding. One of the viewers, RW, wanted to touch base on the semiconductors. I will on a daily chart put in a beautiful, beautiful topping tail on Friday, signifying that this move is potentially exhausted and we could see a pullback to the next support zone. So your next support is obviously going to be this previous pivot high. I would like 160 a little bit better, but ultimately that should see a retrace off of this extension move and reversal candle on the daily chart. Weekly chart though. Weekly chart's interesting because again, you're at a new all-time high in the trend. If we were to simply draw a resistance trend line on the SMH, if you take this high to this high, you can see that potentially there's a little bit more upside room, but even if you were to use the wicks and then the bodies of that candle, you can see we are actually tagging that resistance pivot as we speak. Now, what's interesting, I always like to try to go back to previous patterns on the chart where we had a major top. So this is kind of where you had your left shoulder, your head, and then your right shoulder formation before the SMH had that big drawdown in 2022. And if we were to draw a neckline across, let's just use these pivots, You can clearly see from this pivot low to these pivots, these two pivots, and then your big consolidation range before you had your breakdown, a recapturing of that trend, and then a bigger breakdown rejection. Look what we just tagged. We literally just tagged this trend line. Massive pivot, huge consolidation, bearish breakdown zone, and now you're tagging that level at a new all-time high. It suggests that semis, again, should see a pullback. And in order for this market to remain healthy, I mean, there's nothing healthy that I've seen over the last 8 weeks with this rally. If this market wants to keep marching higher, which in all honesty it could, but if it wants to do it at a sustainable pace, it needs consolidation, and we just haven't had enough of that, in my opinion. Really, that's going to sum up the weekly sector review. I hope this analysis helps everybody moving forward, and definitely be paying close attention to how that XLK ETF reacts at that massive 23-year trend line. Watch out for the sectors that are trying to break out. Many are trying to break out of these resistance points, but if these breakouts fail, then from the biggest, from failed patterns, you get really big and fast moves. So I think these next couple weeks as we head into the new year is going to be very, very interesting as we head forward into the new year. Thank you all for tuning in. Thank you for the comment there, RW. Please give this video a like down below if you found it helpful and useful.